Diane, looking at what exactly we heard from Jay Powell today, it wasn't entirely new. He kept all his options open. I think the clear line, he says, the process still has a long way to go in terms of the effectiveness of the tightening cycle for the FOMC. He says even with the more favorable recent readings. And then this line, I think a lot of investors have been watching to see what this all means for the economy moving forward. The chair saying the wide range of estimates of these lags suggests that there still may be significant further drag in the pipeline, but interesting to see the market reaction.
It is.
The Dow up more than 300 points with about an hour left to go.
And listen, you saw the market. And so the market initially was optimistic as he began speaking, and it was a bit of a head scratcher to me because it sounded like, yes, some people would say it was kind of a neutral speech, and he was straddling the fence on both sides, leaving the door open for the potential for further tightening. But again, just that data dependent message. So, but the theme that it seems that sticks is this higher for longer. We haven't seen this all work out in terms of the economic picture yet and the impact to where the Fed wants to see inflation reside. And again, that talk of 2% and moving away from that target, that's not going away. I mean, Fed Chair Jerome Powell reiterating 2% is the target. That's it. Not 3%. Not anywhere near there. So the next FOMC meeting is just over 3 weeks away. And a common theme we've heard out of Jackson Hole today, you've heard it before. The Fed will be data dependent when making decisions on rates. The Fed will digest a number of economic reports before the September meeting. Yahoo Finance's Josh Schafer joins us now to break down those reports ahead. Josh?
Yeah, Diane. So the biggest thing that stuck out to me from Fed Chair Jay Powell's speech today was he was talking about being attentive to the stronger than expected economic data. And this is one of the first things he mentioned when he said that was GDP, so how much the economy is growing. And when you take a look here, you can see the economy in the second quarter grew at a 2.4% pace. That was not expected at the beginning of this year. People were expecting this to grow significantly lower than that, if not turn negative. A couple quarters in a row of negative normally would mean we're entering a recession. Now, I should note, for the next quarter right now, expectations are for the economy to grow maybe at even double this pace. So right now, you're seeing the economy essentially expand, and that's something he was highlighting. And what's fueling that right now is the consumer. That's a big part of GDP. So when you take a look at the July retail sales number, we saw another tick up. And when you look month over month at what retail sales have been doing this year, you see the last several months, the consumer has been very, very strong and rather resilient. It's not what we saw, way back when, but still resilient and not negative. And that's something that the Fed chair was really pointing out. And where does this come from? Well, it comes from the labor market, right? And that jobs report that we follow each month. You take a look at the jobs report, we've sort of been in a range here for most of the year, just below 200,000, maybe a little bit higher, maybe a little bit lower. But this is another key number that the Fed is following and economists are following to see if we get a slowdown here, because we have not seen a big slowdown out of that range right here. And another thing the Fed chair often points to is labor demand versus how many people are being hired. So when you take a look at this is the total non-farm job openings, this big line up here, and then you see this blue line, which is hires. You can see historically, normally these numbers are relatively in line when we have the labor market that the Fed is looking for. Right now, there's a big gap here. So that's what the Fed is currently looking at to see this come a little bit closer. And we're going to get all of this data, important data, next week. So when you think to next week and what we're going to be able to take a look at then, we're going to see data on inflation, core PCE, and we're also going to see job openings. And what the Fed is going for is core inflation to come down, right? So when you take a look at this PCE number that I said we're going to be getting next week, that's in purple here at 4.1% in June. The Fed wants that to come down to 2%. That needs to come down a long way to get down to 2%. And so that's something that the Fed is watching when they think about jobs data, when they think about how the consumer is doing and how much it's growing, is to get inflation down. Next week, we will get a jobs report and a PCE print. So we're expecting PCE to actually not come down at all, core PCE to actually move up to 4.2% in July. And we're expecting 170,000 non-farm payrolls to be added in that August jobs report that is expected next Friday. So as of now, we are not expecting to see that slowdown quite yet. And remember, that Fed meeting is coming in September. Right now, it's not priced in for a hike in September, But the prices for a hike in November, guys, is starting to pick up a little bit, hovering around 50% now of investors betting that the Fed will hike one more time in November.
We will certainly see if the direction changes in terms of expectations, especially when you see, PCE is the Fed's preferred gauge. So we'll be watching that. Thanks so much, Josh.